There's a lot of noise when it comes to money and investing. Headlines, market predictions, stock tips, and social media experts telling you what to do. But real wealth is almost never built that way. Real wealth is built quietly, systematically, and over time. And the truth is, most people were never taught how investing actually works. Most people think investing is about picking stocks. It's not. It's about building a framework that allows wealth to compound over decades. And that's what this podcast is about. I'm Denise Elshar, and this is Private Wealth The Edit. I spent my career managing money and investments for institutions and high net worth families. And over time, one thing's become very clear to me. The way sophisticated investors think about money is very different from what most people are taught, or not taught, but do. This podcast is about closing that gap. Each episode, I'll focus on what actually matters, cutting through complexity to bring clarity to how wealth is built. I'm here to give you an institutional edge, one private conversation at a time. Welcome back, everyone, and thank you for joining today. Before we jump into today's topic, let's do a quick recap of what we've been working on. We've been building the foundation for investing the way institutional and wealthy families do. And if you're new to this podcast, I would give a gentle recommendation to maybe go back and listen to the first 2 episodes so that we all have those same foundational elements. I make a point of making sure that these episodes are relevant and concise. It is called The Edit after all. So please, if you have a few minutes, go back and take a listen. All right, in episode 1, I introduced the idea that investing is not about picking the next winning stock. It's about building a framework. We talked about how successful investors focus on structure, discipline, risk, and time, rather than reacting to headlines or chasing the latest investment trend. In episode 2, we talked about the framework and took it one step further and explored asset allocation, the foundation of nearly every sophisticated portfolio and what I like to call the secret sauce. We discussed the role of equities, fixed income, and alternatives, and why successful portfolios are really built by combining those building blocks in a way that supports long-term goals. Really, the common thread running through both episodes is this. Wealth is not created through a series of brilliant investment decisions. It's created through a thoughtful system that can survive volatility, adapt to change, and really compound over time. And that brings us to today's topic. It's my favorite topic in investing. It's about time. Because when asset allocation really is the foundation of a portfolio, time is the force that makes it grow. Time is what allows compounding to work. And it's what turns small investments into meaningful investments. And it's the closest thing that investing has to magic. Time. Not timing the markets, not predicting the next market moves, but really understanding the time horizon. And it is the single most powerful variable in your portfolio and the most valuable asset in the world. Let's start with the riddle. What is the only asset everyone receives equally each day? No one can save, the wealthy cannot buy more of, and we spend it without thinking. I'll give you a second. That was a pun. The answer is time. Every morning, each of us wakes up with the same 24 hours. Warren Buffett gets 24 hours, your neighbor gets 24 hours, and you get 24 hours. It is the only truly democratic asset. And yet when it comes to investing, most people spend time worrying about the wrong things. They worry about whether the market will be up or down the next day. They worry about elections or interest rates and headlines. And they spend hours trying to predict what may happen next. But the greatest investors in history understood something different. The secret to building wealth is not predicting the future, it's giving your money time. Time is the fuel that powers compounding. It's the force that allows $1 invested today to become $2, then $4, then $8. Not because you're smarter than everyone else, but because you were patient enough to let time do the heavy lifting. And here's the part that surprises most people. The amount of time you stay invested often matters more than the investment itself. That's what we're talking about today. Not stocks, not bonds, not forecasts, but time. Because while no one can really create more of it, we certainly can use it to build wealth. All right, let's start here. Time determines what risk you can afford to take. I'll give you an example. If you need your money in 6 months, your portfolio should look vastly different than if you needed it in 20 years. You'd have more cash. That's obvious. And here's what people get wrong. They invest long-term money with a short-term mindset. They say they're long-term investors, but they react emotionally to short-term volatility. And that's where returns break down. Time does two critical things in investing. First, it absorbs volatility. Markets will move, and sometimes really quite violently, but over long periods of time, these movements smooth out. Second, it unlocks compounding. And this is the part most people intellectually understand, but I think they completely underestimate. And this is where everything changes, and this is where the magic happens. Compounding is often described as earnings on your investment. But that definition doesn't fully capture its significance. It's the mechanism through which wealth is built. It works quietly, slowly at first, almost in small, invisible steps, and then it accelerates. Compounding is like a snowball rolling down a hill. At first, compounding feels slow. Then one day you realize that your money is actually earning more than you were saving. And when people ask me, really, the secret to building wealth, the answer is just simple. It's time. Time allows compounding to work. And compounding is the closest thing in investing to magic. The earlier you start, the more time that magic has to transform small, consistent investments into meaningful wealth. Let me give you an example and put some numbers behind that to give you the understanding of the magnitude of compounding and time. If you invest $10,000 today, and let's assume a return of 7% a year, after 10 years, that $10,000 will be $20,000. After 20 years, it'll be $40,000. And then after 30 years, it'll be $76,000. Notice something. Growth in the final decade is larger than the first two combined. That's not because the returns changed. It's because time allowed compounding to take over. Compounding is not linear, it is exponential. And exponential growth isn't really intuitive for most people. 10 years you get 20,000, but 30 years you get 76,000. That's not even 3 times the outcome. That's almost 4 times the outcome. And here's the insight most people miss. Most of that growth happens in the later years. Most of the growth happens at the end. Compounding is slow until it isn't. So time horizon isn't just a constraint, it's actually a strategic advantage if you think about it. It shapes what opportunities are available and how a portfolio can be constructed. I say that time in investing is like sunscreen on your face, or if you hate the chemicals in sunscreen, it's about wearing a hat in the sun. The earlier you start, the better. The impact of time or a hat is huge on a portfolio and a face. And start while you're young for the most impact. Here's the uncomfortable truth. Most investors don't fail because of bad investments. They fail because they interrupt compounding. They get out during volatile markets. They move to cash. They wait for clarity. And in doing that, you miss the most important days in the markets. That's the recovery day, the rebound, and that's where the compounding engine restarts. Patience. And patience is difficult in a world that feels immediate. Markets move daily, news is constant, and there's always something to react to. But compounding does not reward reaction, it rewards consistency. At the institutional level, compounding is it's an objective. Portfolios are designed to allow for compounding to occur. We maintain exposure, we manage risk, so capital stays invested, and we avoid unnecessary disruption. Now, let's bring that back to asset allocation and portfolio construction. If your time horizon is long, you can own more equities, you can tolerate more downside, and you can capture more growth. If your time horizon is short, you prioritize capital preservation, which will reduce volatility, and it's going to sacrifice a little of that return, but for certainty. There's neither a right or a wrong way to approach that short and long-term time horizon. The mistake is the misaligning of the two, or said differently, holding a long-term portfolio while behaving like a short-term investor. That misaligning is where investors lose. So if there's one thing I want you to take away from the episode today, it's this. Time is actually an edge. Not market timing, not predicting the next recession, and not finding the next NVIDIA. Time allows compounding to work. it turns small, consistent action into meaningful wealth. It transforms patience into returns and discipline into financial freedom. The investors who ultimately build the most wealth are not necessarily the smartest investors. They're often the ones who start early, who stay invested, and who give compounding enough time to just do its thing, because wealth is rarely built overnight. It builds quietly, steadily, year after year. And then one day, what seems impossible becomes inevitable. So next week, we're going to tackle another one of the most misunderstood concepts in investing, and that's risk. What is risk, really? And how much risk should you take? And how do you know if your portfolio is taking too much or too little? And perhaps more importantly, how do you build a portfolio that allows you to stay invested when markets inevitably become uncomfortable? Because understanding risk is what allows portfolio compounding to survive long enough to work. That's what we're going to tackle next week. It's time for the market edit. Let's turn to what's happening in the markets right now. In keeping with that time theme, my son graduated from high school this week. Blink and you miss it. Yesterday he was dressed in a Spider-Man Halloween costume, and today he's dressed in a cap and gown and heading to Villanova in the fall. And like every red-blooded American teenage athlete, he loves steak. I think he could eat steak for breakfast, lunch, and dinner. So we went to a steakhouse to celebrate after graduation for the family dinner, and holy moly, the prices. It had me asking, where is the reasonably priced steak? And if you're old enough, you may remember that really cute Wendy's commercial in the 1980s, and the tagline was, "Where's the beef?" Today, Americans are asking a different question. Where's the reasonably priced cheap beef? I was reading the Wall Street Journal this week, and there was a reporter that was talking about steak prices in Omaha, Nebraska. So right in the heart of cattle country, where you would assume it would be reasonably priced, it was not. An 11-ounce filet was $62, a bone-in ribeye was $90, and a tomahawk steak was $137. Okay, so that's cheaper than a New York City steakhouse, but it's still pretty steep if you ask me. And the restaurant was packed. Why are steaks so expensive? And the explanation is surprisingly simple. America does not have enough cattle. The cattle herd is currently the smallest it's been in 75 years. How do we get there? Aren't we in the land of cowboys and ranchers? How is our herd so small? Well, first came COVID. Meat processing plants shut down or slowed dramatically as workers got sick or they had to do the spacing, and ranchers suddenly couldn't sell their cattle. And many were forced to take on debt, really just to survive. And then came the drought. So across much of cattle country, grass disappeared and feed costs really exploded. Ranchers were forced to reduce their herd sizes, selling cattle, or actually leaving the business altogether. So the result is really a classic supply shortage. And here's the important part. Unlike most products, cattle can't be manufactured overnight. Even if ranchers decided to build their herds, it would take years before those calves were ready to sell, which means prices will continue to stay elevated for some time. You might be wondering why we're talking about steak prices in an investment podcast. Well, that's because it really isn't about the story of beef. It's a story about scarcity. The reason beef prices are high today is because America doesn't have enough cattle. Years of drought and pandemic disruptions and herd reductions created a shortage that can't be fixed overnight. And even if ranchers decided today, it would take them years to rebuild. Now think about electricity. AI is creating an enormous surge in demand for power. Data centers require vast amounts of electricity, and demand is growing faster than utilities can build new generation capacity. And just like cattle, you can't flip a switch, no pun intended, and create more electrical supply. A new power plant can take years to permit, finance, construct, and connect to the grid. That's the connection. When demand rises faster than supply can respond, prices tend to stay higher for longer than most people would expect. Whether we're talking about beef, electricity, copper, natural gas, or housing, the investment lesson is the same. Scarcity creates value. The most attractive investment opportunities often emerge when something is difficult to produce and takes years to bring online. And that's why we're seeing such strong performance in areas like semiconductor, energy, infrastructure, utilities. These are companies that support the build out of power generation and the AI infrastructure. That's today's beef. And as AI continues to reshape the economy, the companies that generate, transport, and manage power may become just as important as the companies that build the AI itself. The lesson from an expensive steak is simple. When supply can't keep up with demand, prices stay higher for longer than most people expect. And when that happens, the owner of the scarcest assets often benefit the most. If you're interested in this topic more, I have a nice blog this week that I put up on the website called Where's the Cheap Beef? That's the market edit for this week. So if there's one idea to take away from this week's episode, it's this. Time is the edge. It turns volatility into return. It turns consistency into wealth. It allows compounding to do what it was designed to do, because wealth is not built in moments. It's built through a process, one that unfolds slowly and then all at once, and one that, like fine wine, gets better with time. Again, tune in next week. We're going to talk about one of the most interesting things next to time, and that's risk. Everyone says they're comfortable with risk when markets go up and down, but how do you feel when your portfolio is, in fact, down 10, 20, 30%? Can you handle it? Can you handle it for a year? And we'll discuss what risk actually means, how to measure it, and why understanding your risk tolerance is one of the most important steps in building a successful portfolio. Because the greatest investment strategy in the world won't work if you can't stick with it when markets get difficult. Thank you for listening today. If you found this useful, follow the show or share it with someone who you think might find it interesting. Send it to your kids. If you have any questions that you'd like to ask or topics you'd like me to cover, please email me at privatewealthedit@gmail.com. And remember, I'm here to give you an institutional edge, one private conversation at a time. This podcast is for informational purposes only and does not constitute investment advice. All investing involves risk, and you should consult your own advisor before making financial decisions.